A trend confirmation strategy is a method for deciding whether a market move is strong enough to trade with confidence rather than impulse. It begins with the idea that one signal is rarely enough. Prices can jump, pause, or reverse for reasons that mean little on their own. Confirmation looks for agreement across price action, volume, and timing before a decision is made. The first scene is observation. A trader watches the market without entering immediately. The chart may be moving upward, but the question is not whether it is moving up for a moment. The question is whether higher highs and higher lows continue to appear with enough consistency to define a real trend. In a downward move, the same logic applies in reverse. The trader is patient because patience filters out noise. The second scene is verification. A breakout above resistance, for example, may look promising, but confirmation asks for more. Is the candle closing above the level or only touching it briefly? Is volume increasing, suggesting that more participants support the move? Does the price hold above the broken level on a retest? These details change a hopeful move into a more credible signal. The third scene is disagreement turned into evidence. A trend may appear strong, yet momentum indicators can warn that it is fading. A moving average may still point upward while volume weakens. Rather than treating this as a contradiction, the strategy uses it as a test. If multiple tools still align, confidence improves. If they begin to diverge, caution rises. The next scene is timing. A confirmed trend does not mean entering at any price. It means waiting for a setup that respects the trend while controlling risk. Traders often look for pullbacks in an uptrend or rallies in a downtrend, then wait for price to resume in the same direction. This reduces the chance of buying the top or selling the bottom. The turning point comes with risk management. Even a confirmed trend can fail without warning. A stop loss is placed where the original idea would no longer make sense. The goal is not to be right every time. The goal is to avoid large losses when the market changes its mind.